around the end of every calendar year, all the big banks and most investment companies release updated economic and investment outlooks. These outlooks come in two forms. The first is usually an outlook for the coming year. It's typically in the form of a year-end price target on the S&P 500 or similar index. Then there are longer dated outlooks for the expected return of asset classes, typically over at least a 10-year time horizon. Now, while interesting, the relevant question is whether the outlooks provide actionable insight, which would allow an investor to change their investment strategy by trading into next year's forecasted winners and out of the forecasted losers. In order for that strategy to make sense, the forecasts need to be relatively accurate. So let's start by looking at the short term. And now, reviewing some recent outlooks just as examples, they range from about 7,100 for Bank of America to 8,100 for Oppenheimer, with a slew of forecasts right around the midpoint of 7,600 by Goldman, JP Morgan, Citi, UBS. The implied return ranges from a little over 3% to around 18%, with the average right around 11%. Now, that's a pretty wide range, which means if you're going to trade on the info, you better pick the right strategist and hope that they got the call right. Now, as this graph from Advantage Investor shows, there's been both significant overestimation and underestimation of returns at the one-year forecast horizon. Importantly, negative years have not been accurately forecast as shown by positive forecasts in 2018 and 2022, while years of positive performance have generally been wholly underestimated, typically by double-digit amounts. Well, what if we turned away from annual forecasts and look at some more specific market calls, right? There's some well-known strategists, maybe you've even seen them on TV, and these guys tend to make accurate calls. Well, in a 2017 paper titled Evaluation and Ranking of Market Forecasters, the authors looked at 6,627 forecasts made by 68 forecasters over a period of time. Now, these are professional forecasters and strategists who often have a subscription model where they effectively sell their market acumen and accuracy. Well, unfortunately, the results showed the average accuracy across the group was about 48%. Essentially, is no better than a coin flip. And I think perhaps a more important consideration is the performance of these strategists around inflection points. After all, it probably doesn't matter that much if a strategist forecast a positive return for the S&P 500, and that actually came to fruition. What would be more useful is if they forecast a drawdown, which came to pass, and which theoretically could have been avoided by following that advice. Here, the strategists generally fail. As Nir Kaysar, a columnist with Bloomberg News, notes, strategists overestimated the S&P 500 year-end price by 26.2% average during the 2000 to 2002 dot-com bust, and then they underestimated the eventual price as the economy recovered in the early parts of 2003. In 2008, at the onset of the Great Recession, strategists repeated this feat by overestimating the 2008 year-end value by a whopping 64%. And then underestimating the 2009 recovery. In other words, these forecasts tend to be the most wrong when they matter the most. Well, what if we extend to the forecast horizon? Do market forecasts get more accurate if they cover a longer period? In general, no. There still remains significant differences between realized returns and forecasted returns. Let's look back at the last 10 years by reviewing the long-term returns forecasted in 2015. Now, in 2015, the average forecasted 10-year return on U.S. large-cap equities was about 6.8%. For international developed equities, about 7.3%, and on average, strategists expected emerging markets to top all other public equity with a return of about 8.6%. U.S. core bonds were expected to come in somewhere around 3.3%. Okay, now let's look at the actual result. The S&P 500 annualized roughly 14.8% for the last 10 years through the end of 25. International developed equities returned 8.2%, emerging markets about 8.9%, and core bonds, as measured by the Bloomberg US Ag, returned about 2%. Now, the big miss here clearly is an underestimation of U.S. large cap returns, which more than doubled the forecast. Overall, the estimates for returns of international and emerging markets were actually reasonably close, as was the case for core bonds, although notably, if I had made this video a year ago, international and emerging markets the returns would have been completely overestimated, as it's taken very strong returns in 2025 for international and emerging market stocks to close the gap. Consider at the end of 2024, international had returned roughly 5% for the prior 10 years, while emerging markets was lagging at less than 4%. So the 2025 return added 3% annualized to international developed and nearly 5%, more than double, annualized to emerging markets' 10-year returns. I think the takeaway for me in reviewing these results is that the reports are interesting to review, particularly to see where the research is leading to similar conclusions or views of risk or relative performance. But the information is simply not reliable, and it certainly is not actionable. I don't think you can trade on it. The estimation error simply is too great to attempt to change portfolio positioning based on these outlooks. So, for our clients, we're not going to deviate from long-term strategies based on these forecasts. We're going to stay diversified with an appropriate mix of U.S., international, emerging market equities, and fixed income. If you'd like to find out more about how we work with clients using evidence-based investing, our website is in the description where you can easily schedule an introductory consultation. Thank you.